Great traders don't get that way by chasing prices in the market. The great traders and investors have discipline and wait for the market price to hit a level that can set up for a solid trade. I'm Seth Froiberg, the head trader of SMB Capital's options trading desk here in Manhattan, and I'm amazed at how few traders understand the simple option strategy that we'll be teaching you in this video. Because the fact is that you can get paid for bidding on stocks at your price and continue to be paid month after month until the market finally hits your price and you get the risk-reward trade-off that you were looking for on a stock you like. So stick around. I think you're going to find this instructive. Hi, I'm Seth Froiberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Day and swing traders are taught to be patient and wait for prices to get to levels that create the appropriate risk-reward trade-offs. And so oftentimes swing traders will pick a price and then put in a good to cancel order to buy the shares at that level where they think that the market will fill that order at a price that the market will move away from to the upside once hit. And so let's go back to early 2019 and take a look at IWM stock, which is an exchange-traded fund that mirrors the Russell 2000 index. And as you can see, the stock's trading at 152 on that day. So suppose that the trader is of the opinion that he wants to own those shares at 145 because he believes the stock is likely to bounce from that level, as it has in fact done numerous times in the past, as you can see. So let's say a trader wants to own 1,000 shares of IWM at 145. Well, he could just obviously outright buy 1,000 shares of IWM stock for 152, which would cost him $152,000. But let's look at an alternative. Now, in order to teach you this simple option strategy that's an alternative to buying the IWM shares outright, I need to make sure that you're clear on how equity options work. And I realize that most of you probably know something about how options work, but just for a quick review, and this is going to be fast. What's known as a call option on a stock entitles the buyer of that option to purchase 100 shares of that stock at a certain price called the strike price of that option, regardless of what price the stock is actually trading at any time before that option expires. What's called a put option, on the other hand, entitles the buyer of that put to sell 100 shares of a stock he owns at the strike price of that put, again, regardless of what price the stock is trading at, any time before that option expires. The buyer of the option pays what's called a premium to the seller of the option because the seller of the option is taking the risk that the stock will go past the strike price of the option, in which case the buyer can exercise his option. So in the case of a call, even if the stock has gone way above the strike price of the call buyer can exercise his right to buy 100 shares of that stock at that strike price. In other words, he's entitled to buy the shares way below the market. He could flip them the next minute and make a huge profit on those shares in that case. Or conversely, on the put option, even if the market goes way below the strike price of the put option, the buyer of that put option has the right to sell his shares of that stock at the strike price of the put option that he's bought, even if the stock price has gone way below the strike price of the put, which effectively puts a floor on how much he can lose owning that stock. Now, on the other hand, at expiration, if you've sold a call and the market closes below the strike price of the call, then unless that call was previously exercised, the call expires worthless and the call seller just pockets the premium. Similarly, if you've sold a put and the market closes above the strike price of that put, then unless the put was previously exercised, it expires worthless and the call seller just pockets the premium. Okay, so now with that as background, here is an alternative plan to acquire these shares. And this alternative plan has an incredible feature that most investors and traders don't fully grasp. So let's say that instead of buying the shares at 152 and chasing the price, spending $7,000 more than you want to spend on the shares, instead the trader decides to start selling 10 puts expiring around a month in the future until the market finally pulls back and the 145 puts would be assigned, at which point, as the put seller, you'd own the shares. That's what is known as a cash secured put approach to acquiring shares, and it's a technique we are teaching you in this video. And this will come a little bit more clear as we run through the example. So let's start with February 14th of 2019, which is 30 days from the March 15th expiration. And so if we sell 10 of the puts at 145, and remember, each put is an obligation to buy 100 shares at a price of 145 per share, then selling 10 of them is an obligation to buy 1,000 of those shares at 145. So let's analyze the cash flow implications of this transaction. And as you can see, we sold these for 83 cents. And we multiply that by 100 because each option represents 100 shares of the stock. And we sold 10 of them. And so the total cash received from selling those 10 options is $830. Now, before we get into how the rest of this trade plays out, I wanted to let you know that beyond what we're teaching you in this video, there are a large number of sound, viable long-term techniques for trading options for income. And in that regard, we're currently running a 2-hour free intensive workshop where we'll be teaching you 3 of those strategies that real professional options traders use. And in that webinar, we'll be teaching you a really simple but incredibly effective strategy that some of the greatest investors in the world use all the time, plus an options trading strategy that has a statistical 80% probability of profit month in and month out, plus an option strategy that you can employ with a stock that you like where you'll make your target profit whether the stock goes up, goes nowhere, or even goes down a small percentage. So if you'd like to learn these strategies, then just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open the free registration page in a new window, so don't worry, you won't lose this video. Or you can register for the workshop at optionsclass.com. It's not often that retail traders can be taught strategies employed by actual Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. Back to our cash secured puts trade, let's now move to the day that these March 15th options expire. And as you can see, IWM closed at 154.78 that day, and so obviously no one's going to exercise a right to sell their shares at 145 if the stock is trading almost $10 a share above that, so those options just expire worthless. And when they expire, that original $830,000 that we collected for selling those, that cash flow we get to keep. Okay, so we'll move right into the April trade, and as you can see, the options expiring on April 18th expire 34 days out, and those are selling for a bit less because the stock price moved up from 152 to 154, which makes the risk to the seller of those puts lower. And so the price for the April 145s is lower at 56 cents. And so going through that same calculation, you can see that in addition to what we collected on the March trade, you bring in an additional $560 by selling the 10 April puts. And so if we move forward to the day that the Aprils expire, we can see that IWM closed above 156. And so again, those 145 puts expire worthless. And because they expired worthless, we get to pocket the $560 that we collected. So suppose that we had gone on like this each month, selling the 145s until the stock finally sells off below 145 and the owner of the puts cashes in on his right to sell his IWM shares at 145 when they're trading for less. So let's take a look through how that would have actually come out. And so as we mentioned, the March and April trades both brought in $830 and $560 respectively. And since the stock continued to rally as the April trade expires, the May trade only yielded a $430 cash premium, but that too was pocketed because IWM closed over 155 the day those 10 May puts expired. For the June trade, we received $930, and again, those puts expired worthless, and we pocketed that premium as IWM closed at a little under 154 on expiration day. The July premium was $580, and again, that was pocketed, as you can see, as was the $530 we received for the August trade, although take note of the fact that IWM sold off by the end of that trade down to 148, and so you'll notice that the premium collected for the September trade was much higher than the rest because now 145 is now really a realistic striking distance within the next 30 days. So we're able to actually collect $2,390 for those 10 puts. Now let's take a look at the September trade. This one is essentially the end of the campaign because on August 27th, IWM closed below 145, and thus a put owner might have been motivated to sell his shares for 145 at that point. And so you'd end up buying the shares for 145 if that took place, which would be a cash outlay of $145,000 on that day. But remember, you collected $2,390 and you keep that. It's what you get for taking the risk of being forced into owning those shares at a price higher than the market's willing to pay for them. So that premium is yours and counts towards the cash flow that you collected during the process of this campaign, regardless of the fact that they were exercised while those puts were still alive. So now remember, the whole premise of this trade is that you had the belief that IWM would touch 145 and then bounce, and you were getting paid to wait for that to happen. And so at that point, you'd be long shares, and you're actually happy you're long those shares, and you intend to hold them while the bounce plays out. So let's now move, for example, to the end of the year. And as you can see, the IWM did indeed bounce to 165.70. And so let's go back to the very beginning premise of this video to make clear what's happened here. Remember, back in March when we first started this, the IWM was trading at 152, and we could have simply laid out the $152,000 to buy the shares at that time. So if you had done that, your outcome would have been a gain of $13,700, as you can see, which is a 9% return. But take a look at the benefits of the cash secured puts technique. The technique effectively forces you to buy the shares in a disciplined way. And so you get in at a great price, which starts a superior trade immediately. But at that point that you do finally purchase the shares because they were put to you, you have already gained substantially from the cash flow that you collected by selling the puts as you patiently waited for the market to come to you. And so as a result, you benefit from the lower entry price and the cash flow from selling the puts for a final gain of, in this case, $26,420, which is a gain of more than 18%. Okay, so what I'd like you to take away from today's video is the fact that from here on out, any time that you've decided that you want to buy a stock at a certain price, you should be aware of the option that you have to sell a cash secured put to collect income in the meantime as you're waiting for the market to agree to your price. And the great part about this strategy is it not only produces cash for you while you wait for your bid to be accepted by the market, but, and probably more importantly, it's a great way to maintain your pricing discipline by not entering a trade before the market sets up for the trade that you are looking for, which will provide for, as you saw in this case, a far better profit on the trade than had you chased the price, bought the shares at a price higher than you wanted to, and lost the opportunity of collecting that put premium every month while you waited to pay your price for the shares. If you've watched this video, you've understood that there may be some stocks out there that you follow where you're not ready to buy them in the middle of the current rally, but you may well be interested in buying them at some lower price level. So why don't you comment below which stocks you're following where you see an opportunity to enter into a cash secured puts program. Why don't you put that in the comment section? I'll try to comment on it. Maybe we'll do another video on that subject. Now, just to remind you, as I said earlier, if you enjoyed this video and learned something valuable from it and would like to learn the details of 3 real-world option strategies that professional options traders use all the time, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That's going to open up a free registration page in a new window so you won't lose this video, don't worry. Or you could just head on over to optionsclass.com to register for this free intensive workshop. It's really a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. And please don't forget to click on the subscribe button right now so you won't miss all the free trading videos that we are posting constantly on our channel to help you to improve your game as an options trader.